Hi, this is Randy Finney with the right side of the chart, and this is an early session update for Wednesday, June 25th, 2025. It is 10:24 a.m. Eastern Time as I'm starting the video, so we're about an hour into the trading day. I took most of yesterday off. Was in the morning, and then I had a dentist appointment late morning and just decided to take the rest of the day off, just waiting for the market to do what it needed to do, and that is punch through to make that marginal new high. We'll get to the markets. I'll do this in reverse. I'll cover the markets last. Start out with just answering questions. There were quite a few yesterday, and I made some replies to those today. So we'll go over that. A lot of times I think some others might find some of these useful. Somebody asked about how does gush and drip work. They were confused how oil was down almost 5%, but gush was barely down. There are inverse. There's several out there. At least one. I'm sorry. I believe there's more than one that short crude directly. I don't have those in front of me. You can just do a quick Google search on that, short crude ETNs, ETFs. And I also have under the resources, the ETF Center. I list some in there, I believe. Gush and drip don't short oil. They're just the bullish. They're leveraged long. The oil and gas exploration and production stocks. So stocks that are drilling for oil and stuff like that. So that's why they're not going to track oil. I mean, they'll roughly track it, but not day to day. It's just like the gold mining stocks and gold. That's the same comparison there. Somebody said gold would have a much better short entry. Let me get to gold here because, as I said yesterday, the sell signals that I had covered in the previous video were triggered on both silver and gold. However, as I said, gold's not going to go very far to the downside without the dollar rallying. So gold, there's the sell signals, break of that trend line right there. So we're still on that sell signal, but again, I don't expect fireworks or any breakdown, even a move down to the bottom or especially below that trading range until and unless the dollar breaks out. Let me get to that before I do silver. Silver, we do have, I'm going to scratch this word unconfirmed. That's just something I made up, or I made up years ago regarding divergences. In my book, I like to see when you have a lower high, what you need for negative divergence. This is our divergence line. We've been diverging since back here. That was divergent high 1, followed by a correction. The divergence continued to grow even bigger correction there. We had nearly an equal high right there, so still a divergent high. Should draw like that. That would be a second line. And then this is still the same divergence. Again, it shows when you see it that big on a daily chart, it'll also show through on the weekly chart. That's actually how I have it drawn on the daily from right there to there. So we have divergence, big divergence building on it. And I always say divergence is not a sell signal. Now, what I was talking about before, it is now confirmed because these are momentum indicators. And as I often say, when they're moving higher, as it has been with the rally in silver to this most recent high, the momentum indicators are rising. And they can continue to rise and take out divergence. So again, in my book, I like to see them effectively put in a lower high by making that bearish PPO crossover. So in other words, it needs to roll over, and that's what we have. So again, as I just said, divergence is not a sell signal. It is a condition. It is a condition that much more often than not, which again, it doesn't equal always, just much more often than not, leads to a trend reversal, be it negative or bearish divergence like this or positive divergence. So that's that. And I gave you the 60-minute charts too. I've covered this in recent videos. It's been, silver's been grinding around. It did break out in the upper, above the recent trading range recently. But same thing, you look for these divergent highs, divergent low. You'd make infinitely more money in the last, year or so swing trading silver than buy and hold. It's been just, you can see just very, very tradable. So that's it. So that was the last update I gave you. We had that bearish rising wedge on both silver futures, and this is SIL or SLV, silver ETF. Breakdown there. We hit the first support level, bounce, took that out. And as I speak, it is technically an objective short entry. because we have rallied back to support. Remember, support once broken becomes resistance. But all the better if and when the dollar rallies. I'll get to the dollar in just 1 second. Here's GDX. I've been covering this for you quite a bit too. And recently had that, same thing. The divergence has been building, getting bigger, bigger, bigger. Then we had the sell signal recently of this right here. Draw that out. That's a bearish rising wedge on the 60-minute chart. Hit my first target, that 5082. I believe that was covered in previous videos and or static charts if I got those out. And once that level goes, which I suspect it will, then we go down here. And that's going to be another, to the next target, about another 7.5% drop from where we're at. This is what it looks like on the daily chart. There's a potential trend line as well. I believe that's the same trend line I just gave you on the 60. So that's what it looks like. Big divergence there. And then it is not all about, but to a large extent about the dollar. Again, there are times, as I said, where you get a disconnect, where you don't have the typical inverse correlation, but typically, generally, and you can look at charts, you can go back as long as you want, and I encourage you to do so. Anything I say on this site, double check it. There's a lot of people out there, on the internet making claims and this and that and citing that. And, if somebody makes a claim to something or points something out, I like to verify it because quite often, people are wrong. So look at that, pull a chart. I've done it a million times in the past. I'm not going to do it now. I want to keep this video more streamlined. But you'll see a very clear negative correlation between the US dollar and gold. One goes up, the other goes down. And that's how it works. And again, it's simple mathematics. It's just due to the price of gold being, if you're free supply and demand, dollar goes up, it takes fewer dollars to buy an ounce of gold, and the dollar goes down, it takes more dollars to buy an ounce of gold. And that's why a falling dollar is bullish for gold. Again, there are times where there can be an overwhelming bid or demand for gold that offsets that. Or likewise, you can see, aggressive selling in gold that offsets. But again, you go back long enough and you'll see that it's an unmistakable correlation, the longer term. So this is the dollar, as I mentioned, back here. And that's when we had that first correction in gold. I said we're at long-term support, expected a bounce there. We hit my first target right there. First bright start fell back down. We're still back there. The only difference between now and then is now we have positive divergence. So we did have, as I mentioned the other day, yesterday, the post I got out to, we had a failed breakout. It was a intraday, again, really technically in my book, not a failed breakout. A breakout, if you're trading or analyzing off a daily chart or any time frame you're trading off of, all that matters to officially have a breakout or a sell signal or buy signal is how the candlestick on that time period closes. This is what we call an intraday break. It's a red candle, means we broke intraday and then closed back down below there. So there was no buy signal, at least not on the daily closing basis on this daily chart. And so we're still there. So if we get one, you get a solid break, especially a solid green close above there. Then coupled with this divergence and the fact that the dollar's been holding above support, this is that support zone I gave you, that would be bullish and run us up here maybe and probably get another reaction. That would give us a nice W basing pattern there and then break out. And if that happens, that will almost certainly be a net headwind for gold and likely send it down. So that's it. There's your update on the metals, and just need to see the dollar break out. Or you can also, chart the euro US dollar pair. It's the same thing in reverse. You have this here. You have a nice big bearish rising wedge pattern, and so you need to break down there, and that will bring the euro down, which means the dollar goes up. That's what this pair is, the euro and US dollar. And so this has a positive correlation with gold. You can, I'll just show it here for you. Drawings, comparison, where is it? Here we go. Turn off all those other lines. And you can see it there. You can see, again, when you look at comparisons, you want to see when major inflection points come, the downtrends, and you can see it's been pretty strong. And I'm just on a daily chart. We've seen more of the disconnect in recent years since gold broke out to new highs. It's been in a strong rally. But what you want to see here, you can see an inflection point there where the euro was dropping. And you can see them both climbing, especially on this last leg up. It was a powerful drop in the dollar, which gave a lot of fuel. This is a euro rise, and this is gold right here, and that final thrust up there. And so most likely you'll see both reverse. Yeah, you'll see them reverse if and when this wedge breaks down and the dollar holds and starts to rally off that support level. And again, it's a incremental thing. One day rallying the dollar doesn't necessarily do the trick. It's the higher you rally off and further away from that support I just showed you on UUP, then the more likely the gold buyers and sellers are going to get the memo. All right, so let's move on. Let's jump to the watch. All righty, let's go back to the questions. Someone likes the 50-day moving average. What's your take on LULU? Alan asked. Alan, I can't remember if it was you or somebody asked the other just 2 days ago. 2 days earlier, I posted a chart on LULU, and it did take out that trend line. So yes, it is a buy. Here's the chart. Here, let me just go to the live chart. Probably looking at a nice short squeeze, especially if the market can hold up for a little bit longer. I'll get to the market in a second. So yesterday, while I was out, we did break out. So there's a breakout candle, and it's not running away today. It's actually down a little bit, so it's still post-breakout. The positive divergence has not been confirmed. We need to see some more upside here, and the PPO make a bullish crossover. If it goes much lower, that divergence will be taken out. So right now we have potential positive divergence. This is, Lululemon, crowd favorite stock, just held that previous reaction low right there. Even better, the fact that it broke through their intraday. See that intraday breakout, only to stick, save, and close back above there. Traders look at those previous reaction lows as key support levels, pivot points. And so you had an intraday break. We call that a bear trap. Sucks in some short sellers that say, oh, the stock just broke down to a new multi-year low. They short it, and then rut-row when the stock recovers. And I'm going to get to this and use the same analogy in reverse here in a second on the stock market. I want to see that breakout. I've been talking for months now, calling for about coin toss odds, whether this market would go on breakout, make a marginal new high, and then dump, or fall shy of the highs. And so now we have that check mark in that we've been waiting for. It looks like today we finally have the breakout. So I'll get to that in 1 second. Either way, if you take it, don't fall in love. This is a 1,001% counter trend trade. Counter trend trades by nature have a higher risk of failing and are more aggressive, but the profit potential is usually a lot higher, especially if you get a short squeeze here. My targets right now, minimum target 262, second target about 279.40. And if this thing can get some traction, max target would be a rally back to test the 200-day moving averages and maybe backfill this big monster gap right there, good part of it, up to about 320. So let's just say you're talking 12% to that first target. I probably should, and I will right now. I'm going to pull this target down here. You really want to look at this gap. I'm going to put it down to the top of the candle right there. And let's make that second target right there about 271. And then if it gets over there, it'll probably be some selling. If we enter the gap, then I'll address it at the time. On this one you don't get married because it's in a downtrend. It could have another leg down. There's really not firm evidence of a bottom yet, other than the breakout above that downtrend line, which, like I said, could spark some short covering. Alrighty, next up would be closing high for the Qs. Yeah, they still haven't punched out and made today. I think we just made a new all-time high. I don't closing highs. Some people, whatever. It's semantics. New high, we've been within spitting distance. And so we're talking, for weeks now. So we've gone up. I'll get to that in a second. The market's pretty much gone somewhere. So this was just, someone trying to clarify. They're talking about a closing high, not an intraday high. Can you review the housing markets in your next video? I'm seeing very shady business on Zillow for the San Francisco Bay Area, fake values, history being hidden, owner listings and removing to manipulate market, etc. on some houses. The costs on many houses are decreasing rapidly, or as more houses are up for sale and less buyers. Yeah, this is something I've been following. I picked up on. I came across it a couple of months back in my news feed. And the funny thing is, they were talking specifically. The examples they used was, if I recall correctly, in San Francisco, in the Bay Area. And what it was is a spat. And I encourage you to, if you're not familiar, Google it. The spat between Zillow and Compass. Compass is one of the biggest real estate companies out there. You all know who Zillow is, obviously. And the first article I read, and it just heated up this week. I'll get to that in 1 second. But yeah, there was Zillow. The barons of the Journal, one of them ran this, that they were certain houses you'd look at, they were for sale. But yet Zillow was showing the last update, last time the house was on the market was, 5-10 years earlier on some of these examples. And what that was is Compass thought they'd start to get cute, being one of the biggest or the biggest real estate brokerage firm out there in the country, do these little shadow listings where their agents, when they have a listing, they can put it on and only have it, they don't put it on MLS. So therefore it didn't get fed into Zillow. And so they'd have these listings, and you can read up on why they cite the reasons. But these two have been at it. The CEOs, they've been publicly feuding, Zillow and Compass. And so read up on that. And that's where those hidden listings, they thought they would, kind of create a market where it's a little more elite. So people would come to them. And but again, it's not good, in my opinion, if you start fragmenting the market. As a seller, you want, and this is where Zillow and Compass just stepped up. This is what I read this week, is that Zillow now is threatening, whether they've actually implemented it or not, or they're just threatening to do it, for those companies that do this, because again, they're spatting, that do that and hide their listings, and do those private listings, that if it's done and you go to list your house and your realtor doesn't put it on MLS, make it public within 24 hours, Zillow will ban you. You will not go on there. Imagine selling your house. And that article had happened. Compass was doing this all slick. And, homeowners are finding out, what the fuck? Why aren't I on Zillow? I mean, imagine in this market, it's been, market's falling. The housing market's clearly finally peaked. And imagine, you go with a realtor, you lock into a contract, and you find out your home's not on Zillow. Good luck with that. So anywho, that's what now Zillow's doing, is threatening to ban those. And so, and even if you later on, do the private listing for a month or so, just to kind of feel it out there, you're locked out of Zillow. And so we'll see where that goes. And this only can hurt sellers in a market that's clearly turned. Okay, so the next thing on that, somebody asked, I follow the real estate market, both nationally and regional markets. Being, born and raised in Miami, I've lived there, first half of my life. I'm on the southwest other side of the state. But I follow this market very closely. Not only still have a lot of family there, but it is just kind of one of the key markets out there. Florida itself was one of the biggest, if not the biggest beneficiary after COVID. Everybody moving down here. We don't have state sales tax or state income tax. A lot of people moved here for that. The home prices, work at home, all the benefits. And then, of course, we got hit by a spat of hurricanes, and insurance has gone crazy. But bottom line is, so I'll watch Houston, Miami. I'll watch the various markets in California. And most of them are singing the same song right now, especially, again, these hot markets. I don't care what's going on in any Whoville, Indiana. It's not going to move the national needle. But big markets like Atlanta, Miami, Houston, Los Angeles, San Francisco, those do have an impact. And let's not forget, guys, consumer confidence is driven by two things primarily: the stock market and the housing market, right? We have the haves and the have-nots in the world. And the haves are what drive the stock market. They have a lot of their net worth. Most of their net worth is in their homes, and right behind it is the stock market. Again, depends on what tier of wealth you're talking about. And so when housing prices are either going up or holding up, that helps contribute to consumer confidence being high, and it's a fulfilling cycle. The consumer spends. Consumer spending accounts for about 70% of GDP. So we know that a rising stock market and a rising housing market, or at least one that's held up, is bullish. So let's look at this real quick. And I'm just good again. I encourage you to go here yourself. This is, of course, Redfin, as I said. There it is, Redfin right there. You can type in the city, state. You can look national. You can get all these stats that I'm showing you here. And so what we're looking at here is the median sale price. And so you can see it's been I can only go back on this one 5 years, but it's been a rising market. We all know that. And prices are falling. Okay, Randy, yeah, but that's what happens in a trend. You don't go straight up. So what makes this one any different from this, or any of these other dips along the way right here? Well, one of the things, I happen to be in what would the Wall Street Journal labeled this area, right adjacent some of the places right near where I live in Fort Myers, Cape Coral, Lehigh Acres. They deem that the ground zero of the housing crisis. So I was very familiar with it. I was actually working for a brokerage arm of a bank at the time as an officer of the bank, very entwined and working closely with the mortgage loan officers and the commercial lenders and the other bank executives. And so I was acutely aware of what was going on then. And one of the first signs that the top was in, the way it works, and fortunately been around enough real estate cycles, prices go up in a bull trend in real estate. Especially in a frothy market like we've had now, like the last closest, and I don't think we're going to see a repeat of the 2008 financial crisis as far as what happened to the housing market. Anything is possible, but I don't see I don't see prices crashing that much. But I do believe the peak is in, and for various reasons, fundamental and technical. But so what happens in a bull market? Prices go up. But then what happened back then, it was actually about 2005. Remember, the financial crisis, the shit really hit the fan in 08. But the stock market peaked in technically October of 07. I'll get to that in a second. There was a near top right before that, just like now. Real estate market actually started leveling out around 05. By 06, it had peaked. But what happened, unlike the stock market often, and the stock market did this recently and probably doing it right now, where it put in a high and went sideways I'll get to it in a bit. But that's what the real estate market did. And because what happens is it's psychological. People, when Zillow tells you your house was 800,000 or a million or whatever the number is, that's your number. And you go to sell and you don't want a penny less because that's what you saw. And so people hold their price. So the first thing that happens is prices level out. And then what makes it different this time, you watch this days on market. In other words, it takes a while for those people to realize, guess what? My house ain't selling. Okay, I'll tickle here with a price drop. So I've been watching this, and the price drops are going up. Days on market, let's take a look at that. So again, what differentiates this turn right here and says it may be the top? Well, days on market. You can see days on market clearly surged. All those other peaks, days on market was pretty low right there. People can, when you're in this level there, it's not a big deal. We just hit a level now. Days on market are where they were back when COVID hit, right? That's where we are at now. And you can see this trend clearly trending up. And again, that is what happens. So home prices level out, then ultimately start to go down. The days on market start to swell. And then you start getting a lot of price cuts. So you can look at all these metrics, fewer and fewer homes being sold. So that's it. That tells you people still have these fantasy numbers and they're not budging on it. And I've been reading it in a lot of forums, and it just seems to be what's going on right now. And then down here, you can scroll down when you go into Redfin, look at homes with price drops. That's the other thing, right? Nobody was dropping. There were fewer and fewer price. This was the red hot real estate market. Bidding wars, people coming in over asking price. It was a great time to be a seller. And then you can see here, price drop started, and you can see them now hitting a level not seen. Again, I can only go back 5 years, not even close. 20% of the homes we're seeing price drops now in Miami. And again, you could go to the hot markets or your home market. I encourage you to do that. Homes sold above the listing price has plunged down to almost none of them. Sales to list price, kind of meh. It's still, but it's backed off. See, this is where almost all homes, close to 100%, were selling, at their listing price on average, and that's certainly trending down. So again, the ones I watch are price drops, days on market, and of course the overall price index. That's the big thing. That's where, because think about it, you've got the people that need to move right now for relocating, whatever reason those people have to move. Then you have the rest of the world, like me, like others that that don't need to move, maybe happy in their home, but they look at their Z estimate. A lot of folks do, and what happens is when the market turns. And unlike the stock market, think of the real estate market like private equity. You've heard about that. That's private equity kind of gets to mark their assets to the way we call mark to fantasy, mark to market. They kind of get to come up with a number, what they think it's worth. In the stock market, everything is priced instantaneous, second by second. You know exactly what Alphabet or Apple or whatever, any publicly traded company is trading. Housing market's not that way. So your Z estimate's going to sit up there nice and fat until somebody in your neighborhood finally cracks and drops that price to a point, and they got to sell no matter what. They got to move. They already bought another house, whatever reason, and boom, that house that your next door neighbors that was at, Zillow that Z estimated $1 million just went for 750 or 800 or whatever the number is. Not going to drop that. It depends on the market, but then that resets, and then Zillow will start to then recalculate. And then when everybody sees their Z estimates going down, so keep an eye on this, guys. The market's not crashing yet. As I showed you, again, you can go to the national numbers. But if you look at here, just like the stock market, it's not gone up now. You look at Miami, prices are now back to where they were in the beginning of 2024, end of 2023. So you start going down here, you're going to wipe out all these people that bought in here at the highs there. And yeah, you could see some problems. Okay, moving on. Enough on that. NASDAQ, NQ is at an all-time high. No, actually, it's not. I'll get to NQ charts in a second. But again, it's 6 to 1, half dozen to the other. It's close enough. But I want to use NQ because I want to compare a chart the last time the market peaked. What point would you add to shorts? I assume on a 60-minute down from all-time high. Yeah, that's what I'm gonna do. Address this in the video here. We need at least some half decent or better sell signals on the market and or of some of the leading stocks, right? I'd be a fool not to recognize the resiliency of this trend. Sellers are just, it's been talked about, with U.S. bombing, first Israel bombing Iran and then the U.S. and the market's just not even blinking. So I've seen markets like that before. And the one thing I promise you is sentiment changes on a dime. When it finally does, whatever that catalyst is, whether it's a single catalyst or a set of catalysts, be it economic data. We've got a couple big reports coming out tomorrow morning, GDP and jobless claims. So that could be it, or anything else, anything else. Who knows? Iran, you got some crazy people leading that country right now, religious zealots that believe what they believe, and supposedly they may have enough material and know-how to have at least a crude nuclear bomb. Israel's bombed the shit out of them. They hate each other. Anything can happen. So I'm just saying there'll be a catalyst. The charts right now, the one thing I'm going to get to the market in a second, the charts are clearly telling me what's coming. My views haven't changed one bit. The longer term charts are still what they were a month or two ago. And I'll get to that in a second. So, however, there's a saying, never short a dull market. It's been dull lately. It's up right now. It's we're flat. The ES is flat right now. Market's flat. I'll get to the charts in a second. But And anywho, so what I've been waiting for, like I've been saying for well over a month now, probably a couple months, I've been putting it at what I call coin toss odds, about 50-50, whether the stock market was going to go on and break out the new highs and then drop or fall just shy. So we got the check mark, all the better. So I wrote this earlier this morning. We hadn't done it yet. That hopefully we'll get that breakout to new highs out of the way this week, and that will set the stage for a failed breakout. Okay, so up until today, we didn't have new highs. There's LULU. I had this chart up. I should mention that. Wait, I thought I covered that. Oh yeah, I did. I already covered LULU for you. All right, so let's go to the market. Let's see on the major indexes. Remember, SPY not there yet. The S&P 500. If I put a line right here, this is where the previous high was right here. Let me change my arrow color. 1 second. So we're a little shy, but again, some 6 to 1/2 dozen other. Like I said, we've been within spitting distance now for a month or more, a couple months actually. We're right there. We did break out of this recent trading range right there, and whether the SPY wants to punch through there or not, again, the charts are telling me the same thing, that any breakout to new highs or even a reversal soon, but any breakout to new highs will most likely fail. Been doing this a long time, and what I often say is breakouts that occur with overbought conditions, which we have here, this is your RSI, and negative divergence, which is what we have on both those indicators, prices making higher highs, much, much more often than not, again, not always, but more often than not, fail. And so it's really been the pattern of the market for a long time now too. So if you look at right here, that's exactly what happened. This was the previous high in SPY right here. This high was ever so slightly a marginal new high. The cheerleaders on CNBC absolutely came out with their pom-poms that day and cheered the new highs in the market, and give you sell signals right there and right after, and that's what happened. And remember, this was long before Trump came out and announced liquidation day. That was right here. I think there was that candle. So the technicals forecasted that, and we got short back there, mainly on QQQ. And again, so that's what I see, a repeat of that. And when you look at even if they want to cheer new highs, take where we're at today. If you look at the pop-up box on the left, let's come across, and let's not forget the stock market is exactly where it was today almost 7 months ago. And if you're analyzing it from the April 7th lows, it's been a hell of a strong market. If you're analyzing this market from a longer term perspective, it's gone nowhere now for 7 months. And the thing is, guys, even if we're going to new highs and beyond, it's burned up a lot of fuel, spent a lot of fuel to get here. It's like entering into the Boston Marathon, but then sprinting the first 100 yards at full speed. So at best, this market, if we're going a lot higher, 10-20% upside this year or in the next year or so, this market's probably going to have to consolidate at best, if not a healthy correction before it can, work off these overbought conditions and punch on out through there. It'd be very atypical, very unusual to see this market just continue break through here and head up. Plus, we've already seen the momentum waning. This is exactly what these indicators tell us. They're momentum indicators, just like they told us back there, that we had negative divergence, and that breakout would most likely fail. And then on QQQ, so we're not there yet on SPY or on the stock market itself. VTI is an ETF. It's probably the most accurate you can get to look at the entire stock market. That's what it tracks. It tracks it tracks this index. It tracks approximately 100% of the investable U.S. stock market, including large, mid, small, and micro cap stocks. So this is the market too, and close again. I would prefer to see a punch. I would hope it happens this week. A punch through there just to get that check mark, just to suck in those new subset of buyers, armchair investors that watch CNBC or the NBC nightly news with Lester Holt or whoever's doing it now, that, they announced the market made new highs, and you get that last wave of what we call dumb money coming into the market. Usually the institutions are selling. But again, be careful there, because although VTI is very close, you can see it had that divergent high there and drop. QQQ, remember, as I pointed out, the NASDAQ 100 looked like it was going to do it back there. Oh, no, that was back in 2022. It put a high in right there. A few months later, when it looked like it was baked in the cake, the NASDAQ was going to break out to new highs because the S&P 500 did. The NASDAQ fell shy, and that's what I talked about. So again, to me, I put 80 plus 90% chance that we're going to reverse soon. Again, it's coin toss whether we're going to make a marginal new high or fall just shy. In other words, it's not worth trying to bet on that new high. At least not my opinion. I've been patient for weeks now, and as I've said repeatedly lately, make a lot of sayings up in the market. One of them is, in life, patience a virtue, and in trading, it's an absolute necessity. And so you just got to wait for that, this market to kind of this rally to run its course, and let sentiment, just let the last buyer buy his or her share, metaphorically speaking, and then the supply demand dynamics shift. And whether there'll be a single, like I said, a single catalyst or multiple catalysts, that's yet to be seen. But the charts tell me something's coming, and something's coming soon based on these, the divergences and the current conditions. Okay, and as far as the timing goes, let's see if I have anything. One thing that'll definitely help. See this level here, about 526. Set a price alert there. That will be I think a very quite bearish, especially if the NASDAQ. We punched out the new highs here. The futures I'll get to in a second. I don't think they've done it yet. Just like last time, they didn't make new highs. They fell a little shy, but that's that recent level of consolidation. We just broke out. That's what caused the buying yesterday, and so far today, we popped above that trading range, and so now a failure back below even 534 puts you in the range and increases the odds, from my experience, once you break above a trading range. If you fall back into the range, you're going to go to the bottom and then usually down through the other side of it. So I'm going to set two price alerts now, one at 534 there and one at 526. And those, so the question was asked to me, what would be a decent sell signal? Those two things. Not all in until you're under 526. At that point, maybe go to a full short position with a stop above the recent highs. Stop above the recent highs. Also depends on your average entry price there. Let's rifle through I'm on the 60-minute chart. Let's look at some of the market leading stocks. And these are where I have alerts set as well. You got to see the leaders break. This is Microsoft, Mr. Softy here. There's 60-minute chart. Big negative divergence on the 60. This is what I like to see on swing trading. I preferred swing trading time frame. I like to see these 60-minute divergent lows, just like that one there. There was one there, divergent high there, big drop. And this is a divergent high. I just need to borrow these letters. Let me duplicate you, take you over here, and that's it. But divergence is not a sell signal. We had divergence here. We had it here, 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 here. Divergence is a condition, just like overbought or oversold is a condition. These are conditions that typically precede trend changes. But what you need, the catalyst, if you will, is the break of support, which is in this case this uptrend line. This price channel we're in. Break of that. We had one little whipsaw. We need next break should do the trick. NVIDIA, just move the needle there. Divergent high. It's a little bigger, slightly above where we shorted it here recently. We shorted it here. Still well within any reasonable stop for the longer term targets. Even the intermediate swing targets on this trade. Big negative divergence, like I said, that's what I like to see. We shorted the stock back here. We shorted it there. We went long here off that divergent low, and that's when I covered everything. We're covering all shorts there, going into the April lows, going full long, and that's it. So watch, rinse, repeat. You can see here, divergent high, drop. Divergent low right there, rally. Divergent high, drop. Divergent lows right there, rally. And these rallies were into, trend lines and 200-day moving averages, other reasons. So this is swing trading, and this is the first divergent high. We've had divergence. We had it here. We had a little correction. This is where it started, but it's just gotten bigger and bigger, indicating a potentially bigger drop once that divergence manifests in the form of a trend change. And where do you have to break? I'm going to move this. I'm going to borrow this line. I'm going to put it right there. I see some nice support, about 141.90-ish right there, a little shy of 142. That should be a level that'll start to accelerate the selling if and when hit. So I'm going to stun alert right there. All right, let's move through the rest a little quicker. Apple's just been dead. Apple peaked back here. Can't get out its own way. They've been left behind in the AI race. They keep flopping with their AI. Now they're talking about maybe buying Perplexity, and I'm sure that's not gonna. They're gonna pay a pretty penny if they do, and we'll see if and how that happens, how the market reacts. Took out this downtrend line, but I don't see a whole lot that I liked. It didn't have a nice divergent low or anything. It did have a divergent low here, and again, that's when I was covering and going long things, and that was the last nice entry in the market that I saw. We haven't seen really, especially on Apple lately. Amazon right there, negative divergence breakdown. Actually, this one already triggered a sell signal, broke down from that little wedge. Back test right now. Technically, that is an objective short entry. Breakdown and a back test of this little wedge there. So that's it. Following the most recent divergent high. But I imagine just like back here when we had that divergent high and that sell signal, or that next one, probably would have posted both these back on the site. Very few, if any, want to short. Why? Because the stock's going up. When they go up, it's called recency bias. It's the bias to believe that whatever's happening will continue to happen just because it has been happening. And so, and just like then in the market, you get these divergent high shots across the bow. The divergence got a little bit bigger drop, and then the divergence got even bigger. Again, it's the same series of consecutive divergences, all starting from the same point, leading to one bigger divergent high and one bigger drop that was, again, clearly priced in. And we were able to get short there and milk a lot of that drop down earlier in the year. Alphabet already broke down, put in a divergent high here. You can see I had this trend line right here. Give you this little wedge here. Breakdown, kickback rally. That one looks done. Meta needs to break this trend line right here. Set a little price alert. And so the more of these that break down, the more likely the higher probability this sell signal will be in the markets. So this is what I'm looking for, guys. It's not just any one index, not just QQQ or not NQ. This is Broadcom right there, another one that's an active short on the site. We shorted recently, I think it was about right here, and it's gone nowhere. It's just eked out a slightly new marginal and still divergent high right there, and needs to take out that trend line right here to get the party started. So I'm going to set a price alert there. All right, I guess I could stop there. Tesla, this is what Tesla looks like. Put in a divergent high here, and so far that marked the high, fell a little shy right here, took out this little minor trend line today. So there's your update on the MAG 10 or 7 or 9 or whatever we just covered. Okay, this is one of my my preferred sentiment indicators I've shared with you many times in the past for years now, including recently. And in one of the last updates, I told you we're getting very close. This is an indicator that I added years ago. It's been pretty reliable. I put a 100-period moving average on the CPCE weekly. Let me clarify, that's the equity-only put-to-call ratio. So this is a measure of put versus call buying in the market. And I've had these zones here forever and a day. This is my green zone, which means you want to buy. This is when it gets spikes. That means everybody's fearful in buying, loading up on puts, betting the market will go down or hedging up their longs, and they're not buying many calls. And so when you get to that level, it's been a pretty damn accurate predictor. You can see these little circles come. and that's where it peaked. We had a series of tags into my green zone here recently. That was one of the best buying ops in years. And then the last time we had it was right there on that correction. So it's a pretty damn reliable indicator. One reason I believe that this is just a bear market rally, again, semantics, whether you make that marginal new high or not. I can show you the stock market hasn't. You look at VTI, I'll get to that in a second. Some of these market cap weighted indexes like the QQQ, they're not representative of the stock market. They're representative of the Mag 7 or Mag 8 stocks. Even the S&P 500 non-equal weighted index is severely skewed by those. But like I said, when we had this the big drop and it was super profitable to trade, there was zero fear. So they're talking about, right now how, they're talking about sentiment in the market, and right now the market's shrugging a lot of things off, but we never had a reset point. If we did see at that drop, if we saw anywhere even close, we didn't even come close to hitting my green zone there. And that means there was no fear when that happened, at least measured by this. And this is, as I always say, I call it the money where your mouth is indicator. A lot of folks will use the AAII, the American Association of Individual Investors, which is a sentiment survey, weekly survey based on what I call a rhetoric indicator. You can say you're bullish all day long, but you don't have to buy a stock. Maybe you're already all in. That's what tends to happen too in a market. When the last bull has bought his or her share, who's left? Nobody's left to buy. So sometimes those indicators, and you can also say you're bullish or bearish. You plan to buy, you plan to sell, but you don't have to do it. When you buy a put or a call, you've actually put your money where your mouth is. You've either made a raw short or bearish or bullish call on the market, or if you bought a lot of puts, maybe you hedged up your long positions because you thought the market was going to drop, meaning you were bearish, you were worried about it. So anywho, just want to point out that that's one of many reasons. I cited it then. The VIX as well didn't get to the extremes where corrections ended. And what I wanted to point out now, again, I've already covered that with you. We didn't get anywhere close there, is that we hit this level. It's this red line. It's just kind of, I placed it years ago, noting that that's where the 100-period MA comes down to. It stayed there. And it's not a timing indicator. I always say that. It typically happens before the top is in. But like most markets, you see that was an initial, we made a slightly higher high, just like now. This is, if you really zoom in, I'll do this for you on another chart in a second. But if you look at, remember, I've said we've been going sideways for about 7 months in the market. That's how most tops are. You have a high, initial shot across the bow, a correction, and then usually a marginal new, meaning slightly higher high. Again, I'll get to that. And that's happened here. It happened here. And these were all the big drops, 21%. This was a sideways market for 2 years with almost 20% drops. And you can see that when we hit that level, this is where, again, not every correction, but every time we've hit that level, without fail, some of the biggest drops, including that last real bear market, have occurred. So there's a lag time, and there's no set formula. Sometimes it comes pretty quick, and like these two here, there was a tag right there. And then sometimes it takes a little while. I just wanted to point that out because this is a reliable indicator I've used for years, and it's finally just come down and kissed that level. And what does it is this persistence. See this red zone? That just like this is my buy zone, the green zone, this is the red zone. This is extreme fear. You want to be buying when this the put call ratio falls to my red zone here. That's when everybody's getting bearish. The first tag goes right there, and then you had another tag there. It said everybody's bearish, buying a lot of puts. And here you had it right there. I'm sorry, you want to sell. I'm sorry, this is a sell indicator. Sell indicator, my bad. We had persistently bearish readings down here to that final one right there did the trick. And this one here did the trick there. And didn't happen actually in the back here in the financial crisis. The VIX and it was moving in different ranges back then. And VIX is also related to put and call buying. So that's it. This just shows you the persistent bullishness. That's why I have it at red zone, meaning these are extreme. Everybody loading up on calls, not on puts. This is when they load up on puts more than calls. I haven't heard anybody talk about, I'm talking about the pundits on TV, articles I read online, um, anybody talking about the yield curve lately. It's as if they've given up. And it has a 100% track record. And the thing about the yield curve, I think why they gave up and inverted so long ago now, and as I've mentioned many times before, unlike a lot of the folks on CNBC, that when they talk about it, they talk about the inversion and then the recession follows. Yes, that is true. Going back, you can go back as far as this goes, at least in the 70s here on this chart. An inverted yield curve has predicted the past 7 recessions with a 0% failure rate. However, as far as the timing on it goes, it's the uninversion of the yield curve that triggers it. These are, I don't know if you can see it in the video. If you can't, you need a brighter monitor, but these are the recessions, these shaded areas. And so after you invert, meaning go below the red line, that's when long-term rates fall below short-term rates. It's the uninversion that right there, and then the recession followed right here. And we've just recently uninverted, relatively recent. Remember, this is all relative. These are, this isn't a timing indicator. So it's not if it uninverted today, the top or the recession starts tomorrow. But it is usually at that point usually within months, once you get the uninversion. So again, it's been so long and we were so far inverted. I think most people have given up on this, but the signal didn't come there when we inverted. It only came recently, as you can see right here and here. We just recently uninverted. That's the 10 and 2-year spread, and this one's the 10 and 1-year Treasury bond spread. So we'll see. We'll see what GDP does tomorrow. That could be it. May not be, but certainly could be the catalyst. Any big uptick, surprise uptick in employment numbers could do the trick, or it could be anything else. There's a lot right now geopolitical. Oh, and let's not forget also I covered this the other day. Crude just had a sharp pullback because of the little kumbaya thing going on right now between Israel and Iran. But the fact is we hit the top of my orange zone, and I've covered this quite a bit recently. If you're new to the site, just bump me under the comment section here, or click on under this post will be USO on the symbol tags. Those are hyperlinks. Click on that. It'll bring you to this chart I did recently where I had an over under where the NASDAQ 100 or whatever index I used. But without fail, it's been a great timing indicator. When we get into my orange zone, all the big corrections in the stock market have followed. So we didn't only just get in the orange zone, we hit the top of my orange zone. We almost got into the red zone. That was the only time we've gotten into the red zone recently. And that also was right there in the beginning of January. We all know what happened to the stock market, biggest drop in years. And that was triggered by that. All the other drops, again, I already covered that. So just because we've abated, it doesn't matter. It's the analogy I like to use as a gunshot victim. Whether it's somebody in the streets, get shot, go into the ER, you might feel okay, at the moment, but you could die on the table if there was some internal bleeding and they can't stop that, or some an organ got hit with irreparable damage. Same thing, a hunter. Sometimes a hunter drops a deer with a heart shot. Quite often they don't. They miss. It's a lung. The deer's going to run off for a while. They got to track him down. And that's in other words, the damage, the gunshot has happened. The shot has hit the market. That's, crude did get there. Again, it's a swift move down. I'm going to say that the pullback was pretty powerful. But again, all these other drops, they might not have fell as fast, but we did abate down to these levels, and it didn't matter because the damage had already been inflicted. Again, I would have you reference that chart. So, the day this stops working, again, this is what technical analysis is, why I do these long-winded videos. These are patterns that, I look for my own things in the market. I'll use things of others if, they have something out there that works. But this is one that I've come up with, and it's been pretty damn accurate so far. And it tells me that, the damage is done, especially if we start to see this creep back up. Because remember, just like my IEF, I had the same thing I gave you on IEF starting last year with these zones. And it's a function of, with interest rates, how long, not just the level, not just the absolute level. We're back into the green zone on IEF. This is my yellow zone where the stock market starts to take note. The orange zone, it really starts to take note. We kissed the orange zone recently. We bounced back out of it. But remember, what you're looking at here, and the market, I think, is not pricing in, is elevated interest rates. When you're looking at this, oh, what are you talking about, Randy? We're going sideways. Well, you look at TNX, the yield of the 10-year Treasury bond, and you go zoom out to the big picture, this is what it is. And so, as I've talked about in that chart on IEF, the yield, the price of the 10-year Treasury bond, it's a function of how high interest rates are that will impact the economy and stock market ultimately, and also how long they stay elevated. So although they haven't gone up in months, we've been in this trading range, and I still believe ultimately we break to the upside, most likely. That's my belief. But unless there's a horrible, big stock market sell-off, you could get a flight to safety bid that brings yields down. We'll see. But all I can tell you right now is these are elevated yields. And the reason this matters when I talk about the function of both time, our level and time, is that every day, every single day, another loan comes due, whether it's a business loan or a consumer loan that was taken out here when we had near free money. I'm talking car loans. Most car loans are what, 5 years? Some are 7 years. Business loans, the small caps are highly dependent on borrowing. And everybody and their brother financed back here. If you didn't finance, if I've said this before, if you were a corporation that carries a good number of debt and you didn't finance and take advantage, refi on these low rates, you should be quartered and drawn, literally tied to a stake, put a cigarette in your mouth, and so we know they all did. Everybody did. My point is, their expectation is they'd be coming due around here. And so as every day goes on, and I'm surprised, as others are, that we haven't seen the impact on the economy, on junk bonds. I very closely watch, credit spreads, differential between treasury bonds and low grade and below investment grade paper. But I have no doubt this is economics 101, finance 101. We know the longer, higher and longer rates stay high, the greater impact it's going to have. And so if these economic numbers start coming in pretty rapidly, we start missing expectations on GDP, industrial production, we start seeing the jobless numbers really start ticking up. I've already showed you the trend. The turn is in. And again, it's I'm not going to use the word baffling me, but yes, I'm surprised the market's holding up as long as it has based on the indicators I'm looking at. And then the other ones that are, I have a watch list of what I call things to watch, and we'll wrap it up here. I'm about to hit the hour mark. This is my TTW watch list called Things to Watch. And at the top today of that list on my biggest losers, Paychex. Paychex is, I believe, the second largest payroll processor. These are tells on the economy. They just reported today, supposedly a nice big blowout quarter, but yet look at the stock. This is guidance. So what this is whatever. I haven't parsed through the conference call or the data, but I can tell you technically, Paychex, you can see right here, we'll see the day is still young. Maybe they'll print back above this trend line, but you're seeing it's at risk of breaking this primary uptrend line. Plus, it's clearly taken out the 200-day moving averages. That's the red and blue line. They come in together. They intersect the 200 simple and exponential. And that's a pretty powerful sell signal, especially if we close below this trend line there. I'm going to give you a little price support right there. But again, the takeaway is I'm not trading this one. I don't have a position. It just reported today. There's support right there. Maybe it bounces, but watch it. Keep an eye on Paychex and ADP. Because if this job market's as strong as they tell us, this is a pretty bearish chart. You can see ADP put in, this was a big divergent high right here. This is multi-year, big divergence, building. Finally, a beautiful sell signal recently. And I highlighted this one already on this breakdown. And we went down. The stock has been falling. It bear flagged right here. And today it broke down below the bear flag. It's testing its 200-day moving averages now. Those tend to act as support. It's not unusual to see a brief dip below them like you had right here and right here, but they define bull and bear trends, so watch this one. And again, The fact that this stock is now fallen 9% off the highs in pretty short order, that's a tell. The other ones I watch are FedEx. That's a tell on the economy as well. Obviously, if the economy is booming, FedEx's business is good. If it's slowing down, it's not. FedEx peaked a long time ago. And I know part of that's probably due to Amazon doing more and more of their deliveries, but there's a failed breakout, and this is a signature trade of a bear market. This stock is in a bear market. Again, this bull market you're seeing in the indexes is all about AI. It's just the tech sector mostly that's holding up. And so I'm just showing you things that are in my to watch list. UPS, that one we had as a long right there, hit our first target, and then it reversed. This is a bear trend too. I mean, this is, again, these are tells on the economy, and they're not shipping a lot of packages. A lot of the money being made, profits on just kind of intangible. It's this AI vicious cycle of spending, which is benefiting the primarily, NVIDIA, and then those big tech companies that are investing heavy into AI. Okay, I think that's it. It's pretty extensive, covered a lot of stuff. And again, just need to see those levels I gave you earlier crack. QQQ, SPY, the new highs. Again, something that I've been saying for months now, coin toss odds, and we're close on SPY. Like I said, on VTI, I already showed you that the stock market right there didn't, still off the previous highs. But you have, when you go back to these weekly charts, it's not here. I have one right here for you. I did this earlier. Where is it? VTI had a board where I drew. No, I'm going to do it right now for you and just show you that that's common to see. If I click on this flattening out before, usually see that before the major tops. We saw that back in, this was 2007, 2008. You saw the same thing back here. Here, I can zoom in for you and go back to that point in time. Nope. Weekly chart. And take it back here. So it's a common trait. When you have the big negative divergences, like you did back then, you had them in place there. I don't have this chart marked up. You had in the S&P 500, everything else, negative divergence. Market made a new high. Cheerleaders came out on TV, told you it was going to the moon. That was a bullish breakout. And it was basically slightly above where the market was earlier that year in the beginning of 2007, early in the spring of 07, early summer right there. Made that new marginal new high, and then the turn came. And then it ended with a beautiful little divergent low, positive on the weekly chart, and that marked the end of the bear market. So like I've said, a lot of times we didn't have, this time around, we didn't have any evidence of a bottom. We did hit some nice trend line supports, key moving average support, that same moving average right there, the 200-week EMA often contains pullbacks. So we'll see where we go from here. Alrighty, I'm going to wrap it up. You guys have the levels to watch, what we need to see to give us some decent sell signals on the market. Otherwise, let it do its thing. We should get it, nice. I'd love to see a little like short-term blow-off top in the market, but who knows what we're going to get. Like I said, some indexes they all may break out the new highs, maybe only one, or none of them. I think, well, no, we already did one today, right? QQQ, I think, yeah. Either way, again, we're talking percentage points, I don't know whether we pop new highs or not. That's all I see, no more than probably 5% above the recent highs. All righty, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.